What's up, future CPAs? If you're prepping for the board exam, you know every single point counts. Today, we're diving into a topic that can be an easy win if you know the secret: byproduct accounting. We're going to lock in the production method so it sticks with you all the way to exam day. Let's do this.
So picture this. A big sawmill is churning out beautiful high-grade lumber. That's the main goal, right? But what about all the leftover stuff? The wood chips, the sawdust? Is that just waste? Or could it actually be a hidden gem that makes the expensive lumber cheaper to produce? That's the exact puzzle we're solving today.
Okay, first things first. Before we can do any math, we have to know exactly what we're looking at. In accounting, words have very specific meanings, so let's get this one crystal clear. Are those wood chips a byproduct, or are they just scrap?
All right, here's the official textbook definition. A byproduct is something with a pretty small value that gets created at the same time as the main product. Think of it like this. You make a blockbuster movie, the main product, and the outtakes are the byproduct. They aren't the main event, but they still have some value, right?
So, what's the difference between a byproduct and plain old scrap? Well, it all comes down to value. A byproduct has a small but real sales value. You can sell it. Scrap, on the other hand, is basically worthless. Another key difference? You might actually spend a little more money to process a byproduct to sell it for more. With scrap, you just sell it as is, right away.
Okay, so now we know what a byproduct is. The next big question is, how do we handle the money side of things in our books? We're going to focus on the best method, the one that makes the most logical sense, the production method.
And here's the golden rule. You have to burn this into your brain. With the production method, you recognize the value of the byproduct the moment it's created, not when you sell it. The second those wood chips are separated from the lumber, bam, they go on the books. That timing is everything.
Okay, here's your big memory hack. Seriously, this makes it so much easier. Just think of the byproduct's value as a cashback rebate. You know, when you buy something and get money back, what does that do? It lowers the total price you paid. That is exactly what a byproduct's value does to the cost of your main product.
All right, enough with the theory. Let's see how this rebate actually works with some real numbers. We're going to walk through a classic example from the Westlake Corporation to make this whole thing click.
So here's the process. Super simple. Westlake dumps timber into their factory, they do their thing, and at what we call the split-off point, two separate things come out. The main product, their fancy fine-grade lumber, and our little friend, the byproduct, the wood chips.
Now for the numbers. Let's see what we're working with. It cost them $250,000, $250,000, to run the process up to that split-off point. Along the way, they produce 4,000 cubic feet of wood chips, and they know they can sell those chips for $1 per cubic foot. So you do the math. That's a total value of $4,000 for our byproduct.
And here it is. This is the aha moment. Look at this income statement. We start with the total manufacturing cost of $250,000. But then, look right there, we have a line that says, deduct byproduct revenue, $4,000. That value isn't some extra income at the bottom of the report. Nope. It's a direct deduction, our rebate, from the cost of making the lumber. So the true cost of making that lumber is now down to $246,000. It's that simple.
So what does this look like from an accountant's point of view, like with the journal entries? It's a super simple three-step dance. Step 1, the second those wood chips are made, they're recorded as byproduct inventory on the books for $4,000. Step 2, we immediately credit or reduce the work in process for the lumber by that exact same amount. And step 3, the result? The final cost of our main product, the lumber, is officially lower and way more accurate.
Okay, we've gone through the logic. Now let's do a rapid-fire review to burn this into your long-term memory. This isn't just for your next quiz. This is for the CPA exam in 2 or 3 years. You ready?
Let's go. 1. You recognize byproducts when they are produced, not when they're sold. 2. Their value directly reduces the main product's cost. 3. Your mental shortcut is the word rebate. 4. Why is this so great? Because it perfectly matches the value you created with the costs from the same period. And 5. The bottom line for any theory questions. This is, without a doubt, the conceptually superior method. Got it? Good.
So that leaves us with one last big question. If the production method is so much better and more accurate at matching costs and revenues, which is, the whole point of accounting, then why would any company ever choose to use the simpler but less accurate sales method? It's a good question, and one worth thinking about. Until next time.